Okay, may I invite everyone back to the seats, and we are about to start our afternoon session. Thank you. And good afternoon, everyone. Welcome back to the 2023 Annual AASB Research Forum. By way of introduction, my name is Al, and I'm a staff member at AASB, part of the Research Center, working together with Eric. I hope you all enjoyed the session this morning on forward-looking information. What's coming up next is a much anticipated session on the climate-related risk in the financial statements. We have been talking about climate in the week and also this morning already. And so it will be the same format. We will start the session with two presentations from our researchers, from our academics. Dr. Tanya Fiedler from the University of Sydney, and the second session will be presented by Professor Melissa Chen from the University of Wollongong. In case you have any questions to our presenters, for everyone here in the room and also for everyone joining us from Melbourne, you can use the QR code to send through questions, or you can send your questions through the website, which is pigeonhole.at. That is pigeonhole.at, and the passcode is all in capital, AASB 23. And for people who are joining us online, you may send through your question directly through the streaming service. So without further ado, I would like to invite Dr. Tanya Fiedler to the stage for her presentation on climate in accounting standard.
Okay, well, hello everyone, and thank you very much to the AASB and to Al and Eric and my academic mentors Lee Merman and Mark Shine for their support throughout this project, and also for the opportunity to be able to present this research here today. So this is a project that is a collaboration with EY. I'm working with them in terms of, or they're helping with contact with their audit partners and also with some of their clients. And it arises from a long-standing interest that I've had in the translation of information that arises from the climate sciences, also from engineering and from economics related to climate risks, and how that information is then translated into financial values. So I come from a consulting background, an environmental consulting background. So this is a problem, this issue of connectivity that we were discussing back in 2007. So it's great to see that it's being openly discussed and debated now. Okay, so here's the clicker. Let me just see. Is that it? Okay, so just very quickly, I'll just provide a brief overview of the project, the methodology that we've employed, some theoretical framing and findings, and I'll try in the conclusion, and very much agree with Marvin's point there. I'll do my best to provide some form of recommendation that's of relevance to policy makers and standard setters, but we are a little challenged as academics in doing that. Okay, so in terms of the overall aim of the project, this was a project that I first began to discuss with EY towards the end of 2021. So this was before the discussion that really sort of hit the pavement this year around connectivity. And the aim and the research questions that we derived together was really to understand the impediments to and the opportunities for the disclosure and audit of climate-related risks in the financial statements. So in 2021, 2022, we'd obviously already had a few years of TCFD disclosures, and it was already being observed in the marketplace through various reports from the service sector as well as from users that disclosures were not appearing in the financial statements, or if they were in very, very limited form, as Alison mentioned, the comparison, say, between what's happening in the front half of the report versus in the back half of the report. So the question is why? And then the first research question related to that is whether there are issues relating to uncertainty or timeframes, the quality and reliability of the information. And this sort of feeds into my interest around particularly the science. So in contrast to some of the presentations today, I'll probably bring a little bit more around physical risk, as well as some around transition risk. And obviously there are real huge complexities when it comes to climate science information and being able to communicate that and understand it in a way that it can be brought into the internal systems of a company and then translated into information that is useful for financial decision-making purposes. The second research question was then specifically looking at the accounting standards themselves. So how does the climate system, and included in that climate, say within the economy, so transition and physical risk, how does it interact with the accounting standards? And are there tensions there? Are there areas that maybe need to be closely looked at by standard setters and policymakers? And then the third question is whether or not any modifications should be made to standards or to policy. So I'm not going to go into this slide. I think most people will be familiar with all of the developments here, but I just really wanted to highlight that. So we've come a long, long way, haven't we? You know, we started in 2017 with TCFD, and by God, everyone's been busy. So we're now at a stage where the AASB have released their exposure draft standards, the ISSB have released their standards, and we've got this discussion now around, well, how do we connect these sustainability standards with our existing accounting standards, and what sort of challenges result from that? So hopefully this project very much ties in with the questions that are arising from all of that work. So in terms of the methodology employed, there is some archival analysis, which I won't be talking to so much today, but longer term the project is certainly looking at quite a number of documents, webinars, etc., released by various standard-setting bodies internationally and domestically. But what I'll talk to today in particular are semi-structured interviews that I've been conducting with audit partners, preparers, standard setters, again, international and domestic. And I haven't yet approach the users, but yes, you've been warned. You'll be getting a phone call from me. So yeah, and the data that I've got so far is really, really rich. So I'm going to do my best to present it today, but it's by nature limited just because of the time constraints. And this is in addition to, I have since 2019 conducted over 100 interviews with a whole host of stakeholders in the climate related domain. So it's very much an area of active interest for me. Okay, so now I know theory is not top of the agenda in a room full of policymakers, but I'm just going to very, very lightly touch on this concept of boundary work. And the reason I want to do that is actually because of a comment that was made by one of my interviewees. And they said, and I'm quoting here, so someone, either the IASB or the ISSB, needs to define the key criteria to determine when information on forward-looking estimates can and should be presented as qualitative or quantitative, as financial or non-financial, as sustainability related, or you know, should it be presented in the sustainability report, in management commentary, in the financial statements. And this is a theme that actually came up in quite a few of the interviews, the desire for leadership, okay? And there was, I then had contrasting comments saying, well, this is just the same as any other type of risk. Why should we do things differently for climate? And well, again, there were some retorts to that saying, well, climate is different. The scale of the risk we're talking about here is very, very different. Okay, so boundary work is this idea, and it's a term that was derived by a sociologist to really describe the challenges that arise when you have two different disciplines hitting up against one another. So you'll have different, you might even have the same terminology, you'll have different practices, but you might have different, and you might have different terminology, you might have the same terminology, like for example, likelihood. In the climate sciences, the term likelihood is employed. Likely is also used in accounting standards, yeah, along as with some other terms. So there are these points of tension and resistance between these different intellectual domains, and until you actually define and sort of mark exactly where you fall on one side or the other, you're constantly at this point of tension. And that's really where the preparers are at right now. And I suspect a lot of the auditors as well, trying to really unpick where things should sit. Okay, enough about theory. All right, so findings. Now, as I said, there's a lot going on here. So I've tried to just present it in one simple slide, and I've got some notes here. Also, I like always to make sure that my interviewees have the opportunity first to check through any quotes, so I haven't presented them here today. So in terms of research question 1, how are issues pertaining to uncertainty, timeframes, quality and reliability of information impeding disclosures? Okay, so there's a lot to unpack here. So in terms of quality, there were some preparers who said things like, well, we started off with back of the envelope calculation. So I'm talking here about information that is going to feed into financial estimates. Okay, so it's always view everything that I'm saying in that light. So they might have started off with back of the envelope calculations and they've progressed to spreadsheets. Okay, yay. Okay, so they've made it that far to spreadsheets, but they're looking at hugely complex information. This isn't just greenhouse gas emissions, which also largely exist within spreadsheets. The problem is most of the policies, systems, processes companies have set up are for financial data and for financial information. And they don't yet have, A, they don't have the technologies, and B, they don't yet know how to set up controls internally to enable them to manage the information. They don't even know some of the data that they need yet. So huge concerns around the quality of the data. Obviously, there's tremendous complexity in the data. You know, one of the interviewees said to me, well, we don't even know if we're using the latest science. You know, we have to interrogate that. But how? Who on this team is an expert in the latest science? There's a lack of guidance as to which scenarios we should use. There are no standardized scenarios. And I can't remember who just made the comment just a moment ago saying, well, standardization can sometimes be the enemy of relevance. And I completely agree on that, but preparers are wanting this, even though it's not yet possible. And I could go and spend half an hour in explaining why it's not yet possible, but I won't. And then also this issue of measuring resilience. So again, how do you do that in a way that we feel comfortable with as preparers? In terms of timing, lots and lots of issues there. So from a climate perspective, there are disclosures around short, medium, long-term timeframes, as we heard about earlier today. But then you also have issues, if we think about physical risk in particular, we have issues such as the inertia in the climate system. Okay, so a lot of what will be expressed in terms of warming won't come out for another 20 or 30 years. We have issues in terms of climate projections. Climate projections don't show a signal for climate change until another 20 or 30 years' time, but yet we're wanting to know information on impacts that might arise, say, in the next 5 to 10 years, which means you need to use a different type of climate model altogether. And then we have net zero targets, you know, which again, many of them are, say, for 20 or 30 years from now. And then if we contrast that with accounting standards, and most of you will be familiar with this, of course, the timeframes there are much shorter, particularly around impairments and sources of estimation uncertainty. I'm running really short on time, aren't I? Okay, I'll try and speed up. And then, so with uncertainty again, significant assumptions in the information. And then, as I mentioned earlier, there are really contrasting ways. So on the one hand, you've got climate information that's deeply uncertain, lots of assumptions, et cetera, et cetera, et cetera. And there's this perception of accuracy because you've got these models, these climate models, which look accurate because they're precise, but they're not. But on the other hand, in the climate sciences, for example, you've got 7 measures of likelihood, whereas in accounting, and I know Eric was involved, where is he, in a nice paper a few years ago. Yes, there you go. Where I think you said there are 35 measures of likelihood, or in the accounting standards. So, and those can often be that you might have similar terms that are used to mean the same thing, whereas in the science it's very prescriptive and there are probabilities attached to it and there are requirements for confidence intervals. So again, tensions there. All right, so let me now go to research question 2. So how the climate and accounting standards interact. Okay. Impairment testing, fair value, changes to useful life, provisions, revenues, expenses. We've heard about many of these things today. I'll try and take you very briefly through some of the comments that have come up. So some of the comments have been, well, preparers are already incorporating climate change into their impairments. Others have said, no, they're not. Others have said, well, they are, but we're not sure to what extent. But on the other hand, I've had other interviewees saying to me, well, we shouldn't separate it out because it's an assumption like anything else. But on the other hand, users want to see that information, so maybe it should be separated out. But to what extent? Should it just be one of our key judgments, or should it be something much more specific? Should they specify a dollar amount, or is that too hard? Again, according to one of my interviewees. Then there's also the tension between net zero targets by 2050, or a physical event we know will happen, but we don't know when. And then, of course, within accounting, you've got the fact that these occur outside of the 5-year cash flow forecast timeframe for impairment testing. I'm referring to net zero targets. In terms of fair value, there was a real, particularly within the property sector, a real issue there around valuation. Some think the valuers are incorporating climate into their fair values, others not. Is it being priced by the market? Some feel yes, it's being priced by the market. Others feel no, it's not being priced by the market. Again, there was a cry for leadership. Who's going to ensure that it's being priced by the market? Do we need to ensure it's being priced by the market? Isn't the idea of fair values that the market does its own thing? But can the market do its own thing in this instance? And that's a real question that's being asked. Again, a real sense of, we don't feel we can rely on the market here. In terms of changes to useful life, there are examples here numerous times provided around electrification of diesel fleet, for example. And here, many felt that disclosures or changes were being made in the financial statements, so changes are being made to useful life. But again, there are differences there. Are these explicit? So we have considered climate change, or are they more general? We have updated our useful lives. Or is there a complete absence? So again, users want to see more detail there. In terms of provisions, there was a real divergence of opinion there. So there's this interesting case of constructive obligations, which I'm sure a lot of the discussion over the last 2 days might have been around, where net zero commitments have been made. Is there a constructive obligation or not? And one interviewee said, well, this is certainly not as clear as a warranty provision, which is, I can understand with. So what is the obligating event in this instance? Is it the date when the plans were agreed? Is it when the builders were engaged? Is it when construction was commissioned, say, for a renewable energy project? What happens when plans change? And how are costs allocated over time? Say, if the target is for 2050, but you achieve 50% of your emissions reduction, say, in the next 2 years. So, and then with respect to revenues and expenses, there was a lot of discussion there around, well, to what extent should climate be factored into the disclosures made there? So what method should be made to determine if climate has affected revenues and expenses? And that then leads to question 3. How am I doing? I'm running behind. Okay, so whether standards should be modified. So I've just pulled out 3 of the sort of key thoughts that came out, and they're interrelated. So again, I mentioned right at the beginning this one interviewee who asked, well, what determines, what is the cutoff? What is the boundary, getting to this idea of boundary work, that tips risks, climate risks, into a financial disclosure, and how do we define that? How do we know if something should be disclosed qualitatively or quantitatively, financially, non-financially, etc.? What level of uncertainty is acceptable? And should we disclose confidence intervals as we do, for example, in the sciences? Should confidence intervals be required? If everyone's so confusing my words there. So concerned around uncertainty, should we have confidence intervals? There was a suggestion that we should have a taxonomy of measures that are being used. So, for example, and this relates to attribution of climate change with respect to revenues and expenses. So, or climate, I'm calling it climate additionality. So, so when you have a revenue and expense, to what extent can you attribute part of that to climate? How do cash flows separate climate from business as usual? So when a project, for example, is significantly NPV positive, but it also results in significant climate emission reductions, and then how are assumptions that are made elsewhere, say at the front end of the report, communicated to changes in values at the back end of the report? So yeah, that pretty much summarises those key suggestions there. And then if we go to implications, so I've just pulled out some going off from those. So what are the key criteria that tip climate risk into reporting? That's something preparers would like to see. For how far into the future is uncertainty in the financial statements acceptable, and at what point does the future become too uncertain? How are expenditures or revenues attributed to climate and separated from business as usual? For how long should the attribution be maintained, and when does it become business as usual? How is climate attribution determined, and can a taxonomy of measures and methods for climate attribution be standardised, and should the market be made to price climate? And if so, by whom? So that's a quick, there you go.
Thanks very much, Tanya. That's really packed full pack of presentation in such a short time period. And I'm pretty sure the panelists will be happy to discuss some of the questions on slides later as a panel discussion session. So we all have the chance to go back to them. And if anyone has questions for Tanya, please make sure you send it through the Pigeonhole. And I'm really, really happy we secured you a user interviewees. That's precisely why we started Research Forum at the very beginning, to bring practitioners and academics in one room. So now I would like to invite Professor Melissa Chen from the University of Wollongong to talk about consequences of climate-related disclosures by Australian firms in the extractive industry.
Need to lower the mic. Thank you, Al, and thank you for the opportunity to work with the AASB on this very interesting topic, and a topic we've been working on for a few years. So I'll move to really, because we've heard a lot about the TCFD framework today, and also about the AASB. So some of these slides at the beginning are redundant, and I'll move to really our research question and what we examine. So this was an opportunity to really examine how firms are complying voluntarily with the TCFD framework in firms in the extractive sector, in the mining and oil and gas sectors. So we thought it was a good opportunity to see how firms were faring, the difficulties they were facing in disclosing under the 4 pillars of disclosure. And in so doing, we use a textual analysis measure to create a vocabulary, a climate change vocabulary, in order to examine how firms were disclosing in these 4 categories. So what resulted was an aggregate score, overall score for climate change, and also individual scores in the various categories. So now I'll go back to what firms are recommended to disclose under the framework, just to give you an idea of perhaps the difficulties with disclosing some of the information. And this will put our results more in context when I get to them. So with governance, firms are required to disclose on board oversight and management of the climate risk and opportunities. So oversight and management. Under strategy, there are three questions here, or three issues to disclose. They have to do with the horizon, the strategy horizon, the impact and resilience. And that's where the scenario analysis falls in that category. In risk management, generally it's about identifying, assessing and managing the risk. And in metrics and targets, we've talked a lot about that today. It's to do with the performance metrics chosen by the firms and also the target set. And there's also a requirement to disclose scope 1 and scope 2, and if possible, scope 3. So you have an idea of what firms are required to disclose if they comply with the framework. So we divided our sample into mining firms and the energy firms because of the different pressures on these firms and the different operations, and therefore the pressures to disclose. So as you can see on the left-hand side of the slide, this is the aggregate disclosure, and we looked at this data from 2017 to 2022. So you may say, why did you look at it from 2017? How did you get data from it from 2017? So we were very lucky to have jumped on this TCFD train, boat, whatever you like to call it, quite early on in 2020, and had a PhD student, was working on measuring the disclosure using textual analysis. So as you can see, there has been, and the gray graph shows the firms that have signed up as TCFD supporters, and the blue bars are the non-supporters. I have to say, it's an important, there seems to be an important signaling here with firms signing up to be TCFD supporters, because we find quite a difference in results between the supporters and non-supporters. So as you can see from the aggregate disclosure has been increasing over time, but as it's not surprising that the disclosure is obviously higher and better in these TCFD supporters. So to date, we have 20 TCFD supporters in Australia in the mining sector. What is also very interesting is the disclosure within the categories. So this is over the time period 2017 to 2022. But what you can see there is that the mining firms disclose, the disclosure scores in the mining firms are very high. The blue bars tell us that in the metrics and targets and also risk management. However, the disclosure in strategy and governance is a little bit lower. The blue and gray bars in the category disclosure show us the difference, the difference between the mean and median scores. So there is a great deal of variety in the disclosure. So coming back to metrics and targets and risk management for mining firms, if you think about what they are disclosing in these categories, and because we use textual analysis in the metrics and targets, we were reading how they set their targets and and what metrics they had chosen rather than the numbers themselves. And it was very interesting to read about, especially in the targets category, how they set their targets, the horizon for the targets, and how these targets were linked to performance and also the current level of emissions. We found that very interesting and really telling as to the firm's commitment to set perhaps more ambitious targets for themselves in the long run. In risk management, that category of disclosure was similar between the mining and the oil and gas firms. Strategy was a very interesting category. It was low in for the mining firms, and very surprisingly, governance. Because if you looked at the questions posed to firms as to what to disclose or what they had to disclose in terms of governance, it would seem a relatively easier item to disclose, but that doesn't seem to have made its way into the final disclosure. And when we move to energy firms, you can see that the disclosure peaked in 2019 and has come down a little bit to 2022. However, for the non-TCFD supporters, there has been a consistent increase from 2017. Now, in category of disclosure, the highest scores went to risk management and strategy. So this was slightly different from the mining firms, and but they're rated lower on governance and metrics and targets. So I applied the Waggle rule here to look at the disclosure made by BHP in 2022. So as Alison said, firms are reticent about being the first movers in this area, but I found the BHP report very, very good, very, very informative. As you can see here, they provided a TCFD index indicating the places in the annual report that where they referred to these individual categories, and they moved on to include a lot of information on metrics and on the metrics and targets, and in some cases they with the renewable energy targets, they mentioned that it doesn't look like we are going to meet these targets, but we've said it anyway. So I found that very comforting to reflect firms' commitment. So there were many references to climate change in the annual reports for the firms that scored high on our measure, and this gave us some confidence that we were picking up on the disclosure that was being made. So as the disclosure, if we look at specific versus generic reference to climate change, disclosures made in the index, in the notes to the accounts, in reference to, for example, in the BHP example, in the impairment and the closure of mines, where climate change was included in the key estimates, and also in the basis for preparation. So it was everywhere throughout the annual report. So for firms that scored the lowest in our measure, there was only one paragraph in the entire annual report that referred to climate change. So there is much variation in the disclosure. So in terms of the levels of disclosure, when disclosure was high quality or there was more disclosure, firms use scenario analysis, referred to risk management, and in governance, the good disclosure referred to linking the delivery of strategy with remuneration, executive remuneration, the discussions with climate experts and the like. I should also say with metrics and targets, what is important, because our measure is based on textual analysis. So we were only picking up on the words, the discussion around the metrics and targets set. In other work, we've collected the actual targets themselves or the metrics themselves, and we found that this is very much linked to the level of emissions in the firms themselves. The second part of our project was to link this disclosure to cost of debt and cost of equity. So the reason being, if firms make more disclosure, and in research we know that if the disclosure is higher, information asymmetry is lower, this should lead to lower cost of debt and lower cost of equity. So here we measured this cost of debt and cost of equity using interest rates over total debt and also the price to earnings ratio. We found in general, when we split the sample into supporter and non-supporter groups, that the cost of debt was indeed lower with supporters, and so too the cost of equity, or a higher price to earnings ratio. So there are benefits, there are consequences, positive consequences of better disclosure. But notice that I did not, we had to split the sample into the TCFD supporter and non-supporter group to show this result. Because when we looked at cost of debt and cost of equity together with just the disclosure variables, there was no consistent pattern in the increase or decrease in the cost of debt and equity over that time. So to conclude, I think I'm the only one who's going to finish on time. So to conclude, yes, there is variation in disclosure. There's much variation in disclosure among the categories and also among the sectors, and it appears that firms find it easier to disclose under risk management, risk management, and also metrics and targets, but have more difficulty with strategy and governance. As I said before, it's a little surprising why the disclosure is less on governance. The good news is improved disclosure does lead to decrease in the cost of debt and the cost of equity, releasing funds for renewable energy projects. Thank you.
Thanks very much, Millie. And yeah, same. If you have any questions, make sure you send it through Pigeonhole, and we have a chance to give Tanya and Millie more time to do any clarification in the Q&A session. Now, I would like to open the panel discussion session. So today we have a really diverse panel with experts from all the field to provide their insights and share their experience in relation to climate-related risk in financial statements. So firstly, I would like to invite David Hardage onto the stage. So David provides expert and authoritative leadership in financial reporting and audit response, both in the not-for-profit and for-profit sectors. With extensive experience in accounting advisory roles at large accounting firms, David offers advice, insights, and explanations on Australian accounting standards, IFRS accounting standards, and also external financial reporting requirements for private and public sectors. Currently, David's primary focus is on ensuring fitness for purpose of the sustainability reporting and its application. Additionally, David has been a proponent of digital financial reporting for over 20 years, and he has presented on reporting issues at numerous conferences and events throughout the years. Welcome, David. And next, I would like to invite Rachel back to join us on the stage. Rachel brings in excess of 25 years experience in Queensland public and local government sectors. She has provided assurance services, and supported clients to improve their governance, financial, and control environment. Rachel is currently a partner at KPMG. Her expertise in financial reporting in the public sector has been demonstrated through her delivery of performance insights to public sector clients, leading key changes in the simplification of financial reporting and delivery of reports to Parliament on public sector performance and reporting. Her reporting and audit methodology skills have been refined through technical lead roles and also training and provisions of through leadership. Rachel is a fellow CPA, chartered accountant, JAICD, and also a member of Institute of Internal Auditors. And we also have a user on the panel join us today. I would like to invite Tim Buckley. The team is a director of Climate Energy Finance Australasia. Tim has over 30 years experience in financial markets, including providing public interest-related financial analysis on energy transitions since 2013, studying China, India, and Australia. Tim has founded Climate Energy Finance Australasia at the start of 2022, having co-founded and worked with a global energy finance think tank, IEEFA, over 2013 to 2021. Tim was co-founder of a startup global listed clean energy equity fund with Westpac as the cornerstone investor. From 1998 to 2007, Tim was managing director at Citigroup, head of Australasia Equity Research, and Tim has published over 100 reports on the global energy transition. Thanks for joining us today. And we have a surprise addition to the panel as well, Matthew Nielsen. So Matthew was not initially on the program, and he has very kindly made him available to join us today. So Matthew is EY Oceania Chief Sustainability Officer and a partner in the Climate Change and Sustainability Service team. He has over 20 years experience in providing advisory and assurance service related to ESG and climate change. His experience spans across both private and public sector, including sustainability and climate change strategies and governance, climate risk modeling, stress testing, sustainable supply chain and human rights, and non-financial reporting. The list goes very long. And Matt has also significant experience in the areas of environment, health, and safety. Matt is the chair of the Australian chapter of the Earthwatch Institute, a member of the TCFD. He holds a master's degree in environment and a bachelor degrees in engineering from the University of Melbourne. Welcome, Matt.
It's a pretty disappointing surprise, by the way.
Last but not least, I'm not sure she wouldn't be offended if I go through her extensive experience again, but I don't think that's necessary after her inspiring speech this morning. So welcome the one and only Alison White to be the facilitator for this session.
Thanks, Al. And as you already know, this is a topic that's very close to my heart. So really looking forward to it and looking forward to all the questions that come as well. So who do I pick on first for the question? Maybe Tim, I'll start with you. I think one of the things as Standard said is we sometimes find it hard to really get a user perspective, and so it's really fantastic to have you here today. What do you see in terms of the quality of the reporting of climate risks in the financial statements?
Thank you. I'll start by saying we absolutely need credible, comprehensive, globally comparable climate statements, and they need to be comparable, and they need to actually be comparable across the sector as well, so that you can actually compare and contrast. And so to me, we've got some of that information. We've got a long way to go, but I also am sick of hearing excuses. I know a lot of companies, a lot of auditors, a lot of accountants will be saying, oh, but we mandatory reporting from next fiscal year, like we can't do that. I'll remind everyone, the chair of the Financial Stability Board in 2015 was telling us we have a climate crisis, we have a systemic financial risk, and we need to act on it. The Glasgow Finance Alliance for Net Zero Emissions has 700 of the world's largest financial institutions who've all committed to alignment with 1.5 degrees and net zero emissions by 2050. And they did that 2 or 3 years ago. So I don't need excuses as to why you need another couple of years to prepare, or the board needs excuses. And I think one of the earlier speakers said, don't let perfect get in the way of good. We need as much information that is materially relevant today, even if it's roughly accurate. I've been in finance for 35 years. Roughly accurate is more than good enough. In my line of work as a finance analyst, 55% is good enough. As an auditor, as an accountant, you'd expect 99%, 100% accuracy, but at the end of the day, financial markets don't wait for the last 5 or 10% of information. They start to move as soon as they realise their competitors are going to know about the information, and they will move rapidly. So I think we need to move a lot faster than we are, and I don't want to hear more excuses. I love the fact the Treasurer is has proposed a mandate for disclosure from next year with effect. The TCFD has been around for a long time. I want to see it actually done properly. And maybe I'll finish on that. Thank you. Maybe I'll finish, and I'm very good at throwing rocks because I've got the luxury of working in what I consider to be in the national interest. We don't have any paid clients. We don't have any government funding or finance industry funding, which means I can say what maybe a lot of you are thinking. I'm going to pick on BHP, and Millicent did say BHP's disclosures are excellent. They are. They're first class. Their alignment with the science is BS. So let me just reconcile that square and circle. BHP says that they've committed to net zero emissions on scope 1 and scope 2. They've said that they're going to align with the climate science. But they also tell us very categorically that their emissions in the next 7 years are going to go up by 12%. Now, last time I checked, down is not up. Up 12% for Australia's biggest company in the next 7 years is a travesty. So it doesn't matter how good their disclosure is. And Professor Fiona Wild's been on the TCFD. She's been putting her heart and soul into that project for the last decade, but her CEO has signed off on a 12% increase in emissions for BHP globally in 2023 to 2030. Now, last time I was with Fiona, she said she's absolutely certain BHP will exceed that target. I hope she meant under-deliver on it. I don't want them to exceed more than 12% increase in the decade. We must have credible, aggressive action. So that's a big dump on a big company, but to me, BHP is critically important. It's our biggest company in Australia. It's got the biggest balance sheet. It's got the luxury of delivering brilliant returns to its investors, and yet it's investing stuff all in actually decarbonising its own balance sheet and its own emissions. So I'll finish by saying, why do I say that? That's a pretty aggressive comment, right? 1% of BHP's energy use globally in 2022 comes from renewable energy. Now, how can I say that? Because BHP's disclosure is really, really detailed. Like, it takes an hour to download the Excel spreadsheet that Millicent mentioned. It takes an hour, it's that big, and 1% comes from renewable energy, 62% comes from imported, high emissions, expensive diesel. That's not a climate leader. That is a massive laggard, and them signing a couple of PPAs this year doesn't gel with what they've done in the last decade, and so we need substance. And so it's all very well having really good accounting standards. We absolutely need that, but we also need good corporate governance, and we need boards that actually have a skills matrix aligned with the needs of investors in a sustainable planet. And I'd argue BHP's board lacks the core skills matrix that actually makes the use of that data relevant.
So many interesting comments I'd love to pick up on in there. Yeah, I think there's an interesting challenge as to whether accounting standards or sustainability standards will drive the right behaviour. And, you know, I think we're all hoping it will, because the transparency will be there. But obviously it's not going to happen immediately. So I think going to be interesting. Matt, I might move to you next in terms of, there are companies that are reticent, and I suppose I was thinking as you're talking, Tim, well, you've already picked up on things, you're going, oh, I'm not sure about this. And for a company, it's actually been brave and gone out there and led from the front. So that's the challenge, I think, why people are reticent. But Matt, I'm keen, you speak to many companies. What do you see as driving the reticence from the corporates in terms of diving in quickly?
So let me start by saying I agree with your first comments, Tom, but BHP is my client, so I need to be very careful about what I say on the second half of your statements. But, you know, I think in absence of other policy, disclosure alone won't save the climate problems. I think we all acknowledge that. But it is crucially important to be able to start this shift of getting capital to be going to the things that are actually going to achieve the outcomes we look for. And one thing I would say is that the more agnostic we can get about those solutions, such that they are about economically efficient, they are delivering the outcomes that we're seeking to deliver, and that people are being rewarded for the right actions and punished for the wrong actions, that's where disclosures and transparency can really help us. And so I take your point, Tom, but as an investor, I hope that investors or users of this information, investors are using that information and actually understanding, well, what does it mean for BHP if they're saying 12%? Why is that? What's the ups and downs, context of the potential financial implications of that? And how does that stack up against other places that I can place my capital? And if we then get changes in the way capital is placed, that will drive action. So if suddenly BHP put out that when we've got a comparable kind of S2 report in Australia, and we can look and see that BHP is 12%, Rio's
minus 50,
and so on, and the right disclosures around that, we can start to say, well, actually, you know what, I do feel like this company is preparing for the change and the transition and the risks that are coming better than another one. One thing I will say...
Sorry, we have to... sorry, you accepted that interjection. I'll do it again. Right. Rio is minus 50, BHP's plus 12. Investors can clearly see the difference. We don't need 1,000 pages of disclosure to realise that Rio has committed to it. Now,
no, but just emissions alone, and this is... I did say this to you, didn't I, Alison?
You
it will
did.
be a great panel if we get disagreement on the panel. It's always a great panel. So
I'm good for that.
Yeah. The only thing I would say is that, and this is why I think if you actually look at the exposure draft and the requirements of the exposure draft that identifies both risks, opportunities, scope 1, scope 2, and scope 3, as well as other metrics. You can't look at the one metric and the one target in isolation and get a picture of what potential risks are for an organisation. It is one part of the puzzle. Absolutely important part of the puzzle, but only one part of the puzzle. So for example, if you actually looked at BHP, say 5 years ago, they had a significant petroleum asset within their business, and as well as that, they also previously, before that, had a lot of energy coal in their assets. If you actually looked over the journey in the context of their emissions and their portfolio of their emissions, looking purely at the risk within their portfolio, it has significantly reduced over the last 10 years. Now, you might, as a user of those reports, say that it's not going far enough on reducing the risk in the next 10 years, and that's exactly what we want investors to actually do against equities. But I would say it's the suite of information that's necessary in order to make informed decisions about both climate risk and opportunity. Because BHP, if you actually do look at their disclosures, will actually show you that they're better off when the world moves to a 1.5 degree world than they are in a 2 degree world. Now, there's a whole bunch of assumptions that sit behind that. And what investors need to do is better educate themselves about being able to unpick those assumptions, because the assumptions are very, very important to the decision about your making. But that's where we get these disclosures and why they're so important.
Thank you. And I did ask them to interject as well. So not only did Matt say this would be far more interesting if everybody disagrees, just to get some discussion. So thank you. Rachel, I might come to you next. No boxing gloves needed. I think the one thing is some of the feedback we've had is, well, climate's no different from other risks for companies. Why are we making such a big deal of this? And why is this different from business as usual? I'd love to hear your perspectives.
When I think about risk, I think we need to think about risks that make it into financial statements as well, because there are lots of risks that a business face that actually don't make it into financial reporting. So I think it's thinking about the link between the two as well are really important. And I might start on the risk side. So I work with a lot of businesses in terms of identifying enterprise risks and operational risks, how you work out what they are, and then how you quantify the effect on your business. And that's a really forward-thinking thing. And what we do see is that is actually embraced within a business. We don't necessarily see that climate's fully engaged in there yet. What you do see is that it is actually there and entities are responding to it. And it really depends on the industry that they are working in. Some are obviously it's full-blown in there. Others, which are not perhaps in an industry directly affected, are still working through what it means for them. The risk then affect strategy, or they're interconnected. And so what we're seeing is businesses actually respond to those risks. In some entities, we see a great budgetary response. So how is this actually going to affect our budget? Budgets aren't reported, by the way. That's the stuff that's inside the organisation. And I think there's a bit more freedom when something is within an organisation. When you have to put a new lens on the top and say, well, what am I going to tell everybody about my organisation? I've got all of this management commentary and information that goes into annual reports and other statements. I've then got a set of financial statements. The two are linked, but they are separate. Financial statements tell us about something that happens at a point in time and over a period. And that's actually a matter of fact in there. And I think we need to think about what goes where in terms of information for the market as well. And make sure we inform people about where to look for the right amount, well, for the right information that you're looking for. When it comes to financial statements, there's lots of risk that goes into them, because we have things fair valued, things that are uncertain into the future that readers of a set of financial statements need to know. We need to make sure that's incorporated. That's really hard. Like that, they're not easy things to work out, and we know that. We've all been preparers of, or many of us have been preparers and auditors of financial statements. That sort of stuff is really hard, and we need some market consistency in there about how we bring those judgments in, where we've got standard setters and others that bring in those elements. So I think there's links in there. Climate should be in there if there is a direct impact in terms of those fair values, anything with cash flow analysis and the like in there. If it's material, either quantitatively or qualitatively, I personally think it should be separately disclosed that you have considered it and considered it in a certain way. And for that to happen, you also need the appetite of the board. They need to be open to disclosing that information. There's a whole stakeholder relationship thing that needs to happen there from that side. So that's a bit of a journey, I think, Alison, towards thinking about risks as a business and what they do to how it actually ends up in the financial statements.
So what do you think is actually holding them back, though? There's a little bit of uncertainty. It's hard. Are there other factors?
Well, I think it's waiting to see what other people do. Yeah, and if you're dependent on funding, you're dependent on investment, you're affected by public policy in some way, you want to make sure you're not too far out of the normal, the average, right? I mean, taking a big stand is a big thing for a board to do, which is where regulators, standard setters and the like, I think, play that role to help direct that attention into the right space.
And I will come back later, because I'm keen to hear from each of the panel members, I guess, what your top tips for the standard setters would be, as well as preparers. So you can have a think about that. I might turn to David quickly. The public sector, where do you see the challenges for the public sector, David? It would be, I think, good to just share for some of those who aren't public sector experts as well. So just to give us a little bit of background and what you're seeing the challenges going to be for you.
Yes, well, there's no public sector international sustainability standard. So what we've got is the private sector based international sustainability standard. The International Public Sector Accounting Standards Board is having a look at it. but they're sort of less staffed and less resourced, and it'll take a little while. So at the moment, we're working on the international one. So the first is scope. If we're going to talk about public sector reporting, what do we mean essentially by government? So the Queensland State Government has already a sustainability report. It's been produced a couple of years already, and that's been essentially driven by the capital markets. So some things there, as far as I know, I don't think they're actually referring to a particular framework, but it's a start. So the metrics and things that they've included in that sustainability report have a bit of a combination of the economy of Queensland versus the government itself as a body. So you've got the state of Queensland. Now in Queensland, and many other governments, you've got sort of three sectors in the government. So you've got the general government sector, which is the departments and statutory bodies. You have the public financial corporations, like in Queensland WorkCover and Queensland Treasury Corporation. And you have the public non-financial corporations, which is like, we call them the government-owned corporations, government business enterprises. So in Queensland, we've got the electricity generators, the transmission company, the distributors. Some of those in other states have all been sold off. We've got water. We've also got some ports and what have you. So they're similar to the private sector. And in Queensland, they are created or registered under the Commonwealth legislation, the Corporations Act. So they'll get picked up with the Corporations Act changes, unlike other states that may have incorporated them under state legislation. So, what does that mean when we talk about government and what is going to be reporting? Now, there is a difference between various jurisdictions around Australia, the different states and territories in the Commonwealth. In Queensland, the approach is whole of government. That's the focus. But in other jurisdictions, they're pushing the reporting down to individual departments. And the question is, well, why? And when you look at the reporting we've talked about, you've seen all the TCFD, governance, strategy, risk management. Well, that's basically all set by whole of government. So, why don't we just state whole of government and do the metrics at the whole of government level rather than reporting and doing all the same stuff against the individual agencies? So at least that's my personal view. And when we're trying to apply these standards, what is materiality? So what is materiality in the public sector? Private sector, discounted cash flows, investors. Public sector, who are the users? What does materiality mean? What does materiality mean when we start looking at the qualitative information? So Professor Chang spoke about, she was doing textual analysis. Now the associated paper talks about giving it a score, and the climate disclosure score. And that score had very wide variation, not just between yes and no TCFD, but within yes TCFD reported. So how are we going to audit that? And we're trying to audit something that is, in what's material, what gets excluded, and what's a bit wobbly. Another term is value chain. What is the value chain for government? Now, the value chain is an important term for Scope 3. So Scope 3 is the emissions outside your control that's linked into your supply chain, your suppliers, and your customers. So what does that mean for government? And do we need Scope 3 as a material? Because when we talk about users, they have a reputation for being like the Cookie Monster, data. So I can see, yes, people will ask for it, but is it on a cost-benefit basis? Do we really want to push this Scope 3 and collection of data into the economy, into small business? I don't know if you've ever spoken to a small business person who has to deal with a large corporate and modern slavery statements and the 8 to 10 page modern slavery statements. I mean, they just sign it because, they don't think there's a risk. But if they have to start filling out data, that's going to be an enormous cost to them and to the economy. So there's some issues that we need to look at as to what are reporting and the various public sector terminology definitions.
Definitely going to be quite a challenge.
Can I, David, you mentioned you think that, sorry, if I heard you right, that Queensland should report at the state level, not at the corporate entity level, is that what you said?
Well, I believe whole of government for the not-for-profit departments and statutory bodies, because they're essentially driven. I can see some merit for the private sector equivalents, the government-owned corporations, to do their reporting similar to a private sector. And actually, in fact, in Queensland, they will be caught by that because they're under
common. They will be caught, but
yes.
Yeah. So you've got a board, you've got one of the biggest emitters in the country, a power generation company, like CS Corp. Those directors have, CS Energy, those directors have a fiduciary duty. If you do the whole of government approach, are you abrogating their responsibility?
They will be caught. Yeah, so there's no, even if we do a whole of government, they will be caught as we see it, both because they're NGAs registered and because they're corporations. So they'll have to follow the Corporations Act, irrespective of any other view.
I agree. That's why I'm picking you up on the point. As an external user, I actually need to know what that company, that entity's emissions are to compare it with their private competitors and to hold the board to account. We will be able to, because as you said, they're a statutory organisation.
For Queensland. Now, in other states, the government-owned corporations
it'd be a lovely problem to have. We've privatised in New South Wales, so
different legislation. Queensland, it's Corporations Act.
It's interesting though, because that assumes a materiality level at a whole of government position rather than an entity level. Take away the corporatised entities, which is different from financial reporting, and I think that needs to be thought about and articulated about why that is suitable as well from a user's perspective.
I'd actually just on that, Rachel, I think you coming back to the original question actually that was asked of you, that you had asked Alison around why is this separate? Like, why do we actually need to do this separately? Why do we need a new exposure draft? Why can't we just rely on existing financial statements and existing IFRS standards? I think it's related to the reason also why I think what you've said about breaking it down to Queensland, I think is more important actually, to have disaggregated reporting around what the disclosures will look like here. One of the things that financial statements aren't very good at is giving you good information about future resilience. They give you a good indication of performance, but they don't really give you a good indication about whether that performance will continue into the future and what is coming down the pathway. There are some obviously disclosures around risk, but it's not super quantified in financial statements. And there is certainly in investor briefings, they start to drift into that and start to give you that sort of information. But financial statements in the past have very much been about performance rather than future resilience. Because of the issues of climate change that are the physical impacts of climate change are so fundamental to the way things will change, you can't use what's happened in the climate in the past to give you a picture of what's going to happen in the future, right? We've kind of stuffed that by putting greenhouse gas emissions into the atmosphere. So this concept of using past financial performance as a measure to determine resilience into the future is broken. So that's why we need this and why it has to include forward-looking statements as part of the disclosures that are required, because we're going to be operating in a completely new world. The second point I'd say as to why it's so important to understand resilience. So that's why I think the disaggregated construct of resilience is really important. How resilient are our ports in Queensland to the potential future risks of climate change? How resilient are our power generators in Queensland, New South Wales, Victoria? This is part of also why it's not just about the investors that need this information, but why we as citizens need this information, and actually goes to the heart of one of the core fundamental reasons that this is so pervasive across the whole economy and systemic, as the TCFD, the Financial Stability Board, talked about it. This is going to impact every business, even if you have zero emissions, because pretty much every business is impacted by the economy in some form or another. And so the concepts here are necessary to give us that picture to understand how do we build resilience into our economies, our organisations, our governments, all of these things as part of the overarching picture. The other thing, the last point I'll make as to why it's different, there is no such, this is COVID, global financial crisis, tech bubble burst, everything rolled into one big thing. That's the scale of the impact that we're talking about that's going to come if we don't sort this out. So you either have one of two risks. You will have Armageddon on the physical risk side. So just remember, we're talking about probably somewhere between 0.9 and 1.1 degree of warming now. And you think of what's happened in the last 12 to 24 months around the world on physical risk. And we're talking about, at best case scenario, is going to be warming of 1.5 degrees. So we're going to add another 50% of warming on top of what we've already got. And that's our best case scenario that many organisations say that we've got a cold chance of hell of actually achieving, right? So then if you talk about what does a 1.5 degree world look like on the transition risk side, what we're talking about is effectively no more fossil fuel-based energy supply anywhere in the world in the next 30 years. No more internal combustion engines anywhere in the world in the next 30 years. We're going to see the emergence of a sequestration industry that's as big as the energy supply industry is today, and complete fundamental shifts in the manufacturing sector and agricultural sector in the next 30 years. So that's to get us to 1.5 degrees of warming if we move now, right? So coming back to your point, Alison, at the start, the reason this is different is when I put that scale out there, the scale of the potential risks to all organisations is something that you can't rely on past performance to give you a picture of, and it's so systemic and significant that it needs to be dealt with separately.
And I think that's probably two of the reasons why people are finding it hard as well. We're not naturally built to, certainly as accountants, to be able to look forward. We're good at certifying what's happened in the past, so it's a whole new challenge for us. And then it's understanding what this future looks like, which we just don't necessarily have all the answers to. And we like things which are quite known. So I think lots of challenges. There is a question from the audience that I wouldn't mind touching on, and then I will come back to my tips for the standard setters. But it's, thanks Marvin, the question really is it the role or the remit of the standard setter to put in place reporting requirements that makes companies be more sustainable? There's a loaded question there.
I'll go for that. Categorically, there is no company or economy on a dead planet. So exactly as you said, we are going to see a global transformation of the world's economy in the next 10, 20, 30 years. It is going to happen. And if boards want to be agnostic to the climate science and sidle up to the continuation of profiteering in the next couple of years and don't worry about the destruction of our planet, that's not a livable scenario. So yes, we do need detail and we need it as accurate as we can get it, but we need comprehensive information. And so I maybe go back to David's comment about scope 3, and it's really hard imposition on an SME to ask them to give scope 3. I'll push back on that because, and you're saying modern slavery, it's very easy for Wesfarmers and Coles and Woolworths, like 3 companies would import 99% of the consumer products in Australia. Let's limit it to the top 100 companies and get them to do it because they can influence modern slavery very categorically, and they are doing that. Leaving up to mum and dad company, scope 3, likewise, BHP, Rio, Fortescue, they can measure their scope 3. Woodside, they can measure their scope 3. They can do it within probably a 99% accuracy, maybe 95%. That's good enough for me. And will it be 100%? No. Can we wait for it to be 100%? No, but we need to really work on what is most material. And so when I look at say a Woodside, 91% of their total emissions come from scope 3. So why would we do endless amounts of detail about their scope 1 emissions, which they're doing bugger all about, when 91% of their emissions are scope 3? I'd be far more interested in hearing what Woodside thinks about scope 3 than worrying about what they're doing on scope 1. I think they should be doing something on scope 1, and the safeguard mechanism will force them to do something on it. But I'm far more material for the world and for their investors what they do on scope 3.
Thank you.
I think, Alison, I might just actually, I think the board and regulators have a role to require disclosure which is material for decision making and things that are material for a business, but I don't think they have a role in terms of affecting the strategy of an organisation. So I think we just need to be very careful there.
Yeah, thank you. And while I'm asking a few more questions, I'm not sure, Dr. Fiedler, Sonia, would you like to come up? There might be a few questions for you and Professor Chang. Thank you. So there has been a question here to say, is there any effort by the AASB or ISB on establishing a format or guideline for specific industry in terms of reporting climate change?
Isn't that the SASB that was originally going to be the industry-based metrics that were going to be in S2, which I understand got pulled out to be mandatory, but then you still have to look at industry or something, and it's like, well, what do you do when the only industry metrics are like the SASB? But personally, having a look through them, it's like, yeah, someone spent a lot of time collecting this great big list, but are they really relevant? So there's one for water utilities that I had a look at, and it had the total number of kilometres of pipes. Well, you know, what does that mean? If it goes up, is that good, or down, is that good? If it goes up, then maybe more emissions or something, but hang on, that's more population that they're servicing. That, to me, that's good. So I go down, it's less service. So some of those metrics I think are questionable, but then they become the standard that everybody then has to tick off the checklist type of thing.
Such a balance, because people want guidance,
yes.
But then you don't want the wrong guidance.
Yeah, yes.
I could probably answer, and I can see Siobhan in there, so she'll keep me on point in terms of making sure I don't say anything I shouldn't. But yeah, I mean, the direction was quite clearly to establish a standard that was industry or sector agnostic. That's what's been done in the first instance, and so therefore, you know, the relevancy and the internationalisation of the SASB metrics is something that needs to happen before we can adopt it here in Australia. And I would say, I think the requirements as they're currently put out in the exposure draft will give better and more information for investors to make appropriate decisions going forward. You know, is it going to be an evolving area, and we'll continue to see potentially some sector-based specific metrics that are relevant for organisations to report on? I think the answer is yes, but for the moment, it's you know, that's not something that we've gone down the path on. The other thing I will make a comment about is guidance. So we again have spoken about guidance at the AASB about providing guidance on how to report and what to report. At this stage, we have deferred that. It is an extremely tight timeline, and I'm very sympathetic to our AASB staff team having to get this out in a very short period of time in terms of the exposure draft itself, based on when we got the AASB standard released, the requirements for Treasury, the mandate to do it, and actually then getting out the exposure draft. You know, for the moment, it's about giving reporters and users of the reports time to provide feedback on the exposure draft, collate that, and then actually get a standard out in time for the start of the Treasury time periods that's been set from us from government of 1 July next year. So guidance will follow, but probably not in the next 6 months, shall I say, Siobhan? She's laughing at me. Let's say 6 months.
I think Matt got a 10 out of 10 from Siobhan for that.
Yeah, I didn't get a 1 out of 10, which is
Can I just jump in and push back on the idea of sector neutral? Sector relevance is critically important for me, and we can't afford to wait. And I was just having a look at Westpac's reports from 2 weeks ago. 99% of their emissions are financed emissions. When you look at scope 1, 2 and 3, upstream scope 3 and downstream scope 3, 99% is downstream scope 3. So if they report 500 pages on their scope 1, I really don't give a toss. How much paper they use, I really don't care. Yet you will get 5 pages on it. And Westpac actually just installed a EV charger in their Western Sydney office. I know that because that's right up front of their climate, I'm being facetious, it's right up front in their climate disclosure in their annual report released 2 weeks ago. They put in an EV charger in Western Sydney office so that their staff can drive an EV. Now, I'm being really facetious because that'll have precisely zero relevance to the world, but 99% of their emissions are financed emissions. So I don't really give a toss what they're doing on scope 1. I don't care about what they're doing on scope 2. I don't care about what they're doing in upstream scope 3, because I'm about materiality. As an investor, what Westpac does in their financed emissions will change Australia, and it will help change the world. Now, that's a big dump on Westpac. They are moving very, very aggressively. It's not meant to be a dump. I'm just focused on what's material. They are one of the Glasgow Finance Alliance net zero emissions signatories. They are increasing their disclosures every year. They are committing to reduce their financed emissions. But again, the annual report highlights that they reduced their Scope 1 emissions by 54%, they reduced their Scope 2 emissions by 53%, they reduced their upstream Scope 3 emissions by 4%, but their financed emissions down 3. So 3 is the only number that's going to be relevant to the atmosphere, yet the big headline is 54%. Like 0.1% of their emissions went down by 54%. Who gives a toss?
So the good news is that under the exposure draft standard, it does require Westpac to report their financed emissions, so we're all good.
Yeah, and they did, and it's going in the right direction. But
You just got 11 out of 10, Matt.
Yeah. Did you sign that one?
So not Westpac. No.
Maybe we can reduce the font size on their Scope 1 emissions from 80 to 4, and their financed emissions number should be font 100.
But I think, Tim, sorry, I feel like I'm dominating, so please jump in, team. But what I would say is this is also about, we do need to get investors to better understand what it is that matters.
Yep.
And the S2 reporting structure should hopefully start to see some consistency, so we can actually go, well, these are the things that actually matter most,
100%.
and we can actually compare them from one to the other. So that you're not kind of drawn to the big font sized reduction point, and then you do know what it is that you're looking for. So that's part of the journey, I think.
Yeah, and it's not the finance analyst who's going to be drawn to that, because as a finance analyst for 35 years, I always just go straight to the back page of the financial reports, but it's the mum and dad investors who will read the first 10 pages and then go for their coffee and bickies. So it's the investor deception of the 99.9% who aren't experts, who haven't been paid a fortune to read financial accounts as their career.
I found that very insightful, and I think that's going to be interesting, this whole debate around materiality as we move forward. We do have a question from the audience about anyone can measure their Scope 3 emissions. If you do not have the data, then you do not know or manage your business well enough. That's a pretty
I've asked
interesting
that question, and I've been told there's an expenditure method for some of these things. So Scope 3 is their suppliers and your customers. And there's something like 14 or 15 different categories, including employee travel. So just imagine employee travel. Okay, which employees go to work every day? Which ones they don't? Do they take the train? Do they take the car? Is the car EV or not? Do they charge their EV at night or not? Are they using solar power batteries or not? So you can get into some really, you know, what are we doing here? Can we do something with estimates, and again, not put it down to, you know, down to the individuals, and go beyond the company and force collection of data beyond what the company has? So I've been told that you can use an expenditure method to do part of the estimation, but if this thing's going to be audited, is that something the auditors are going to allow? In the sense of they're going to be, oh, well, hang on, we know that there's some problems with the expenditure method. Paying more doesn't mean necessarily more emissions. Paying less doesn't mean necessarily less emissions. Are they going to allow that and then sign it off on what we call reasonable assurance in a few years' time? So they're the questions I'm asking.
But is it material whether an EV driver or an internal combustion engine driver at Westpac? It's absolutely immaterial. Make whatever rule of thumb you like, just use it. Go. It won't make any difference whatsoever to the emissions profile of Westpac as an organisation, or any other major financial institution, or BHP or REA, or in fact any of the companies that we're actually studying. It might for a 3-person SME, but you're not auditing them, and who cares?
And that's where we've got to look at the whole, you know, the 14, 15 different categories within Scope 3 and working out what's material or what's not.
Correct. Materiality is everything.
I think it's also something that we were talking at dinner about last night, Matt and I, around you want to be able to manage those emissions where they are material, and there's some that won't be material. So Matt gave me the example of, you know, our staff travelling to and from work, but then what can we control? We can control their flights that our staff go on, and depending on what you do in your business and how often you travel, that might be significant. So I found that really insightful.
Yeah, and there are some businesses where that matters a lot. So, you know, we take a supermarket, for example, they are very exposed to a whole lot of Scope 3 related emissions that are about the costs of the products, the use of the products that they subsequently sell. And so they don't have good information around that. So it's hard to actually capture that information, but it is material. So unlike
for them, 100%, logistics are their entire business.
Well, logistics is big, but it's actually the products that they actually import into their business themselves, so that they subsequently sell the chips, the lollies, whatever it is that they sell. Some businesses will need to spend quite a lot of money to actually understand, in order to make appropriate decisions, in order to reduce the risks in their business going forward. So that comes back to that point that if this is a material risk to your organization, and it might cost you, let's say it costs you $5 million, this is not true or anything, I'm just making it up. Let's say it costs you $5 million to actually understand the most material product input to your business as a supermarket chain. Is that a lot of money? You know, if I said $5 million to this room, everyone in this room is probably saying, wow, $5 million, that's an awful lot of money. But, you know, if you think about the scale of the product that's sold in Coles nationally, on a product that potentially you could make an investment decision on that says, well, I'm going to move from this product to that product, and the movement of that product to this product is going to cost me, you know, $300 million over the course of a year based on the contract that I'm signing, because they would spend that amount of money on product. The amount of money on capturing data in order to make the right decision is not necessarily a big deal. So I 100% agree with this comment around it's all about materiality and picking that thing. But in some circumstances, trying to work out the scope 3 emissions for Woodside, when you know that you sell gas and oil, is easy. Yeah. It's big, but easy. Hard to fix, but big and easy. Working out scope 3 emissions for a telco or a retailer, or Wesfarmers, or for a Coles with any precision that actually does enable you to make investment decisions, very hard.
So it's also immaterial to their business in almost all circumstances, whereas for Woodside, it's the only decision you need to know as an investor in that company.
Yep. Yep.
So I've got 2 questions left and I've got 4 minutes, okay? So one question, I would like to ask the panelists whether there is evidence that the Australian investors reflect climate disclosures in their investment decisions, i.e. are climate responsible entities attracting more investors? So not just talking about, not sort of talking about people who, there's a mandate, you can't invest in coal or you can't invest in particular industry. For people who are doing those climate disclosures and it's evident as to how they're managing their emissions, is that reflecting positively from an investment decision perspective? Do we know?
So we actually do a study on this. We actually ask thousands of institutional investors around the world whether they make decisions based on ESG outcomes, and climate change included in that. 98% of them said yes, they do, which does make me worry about the 2% that no, they don't. Talk to me afterwards and I'll give you the names of those investors so you can pull your money out of it. No, I'm kidding. But they say yes, they do. We then ask questions about whether you make decisions based on a positive or a negative screen. Over 80% said that they do it on a negative screen, then over 60% said they also do it on a positive screen. So what I mean by that is a negative screen in terms of if someone's got very bad ESG performance or very high climate risk, do I pull my assets out, my capital out, and then actually look for other places to do it, and then do a positive screen, which is if this is a positive thing, I'm going to go and put my money into it. So what they are telling us overwhelmingly, and it's increased obviously significantly over time. The bit that we haven't asked, which I think is much more an interesting question, is, and I think you alluded to this, Tim, what's the nuance? Is it, you know, could we actually come up with a view that says I can give a 10% discount on an equity because of their performance or where they're at in their target, or a 10% uplift in the context of a business for doing well because they've improved, for example, you know, do you give a 10% discount on BHP because they're 12% reduction by 2030 versus Rio Tinto? By the way, that's not investment advice, but that's the sort of thing that I think is the next layer of question that will come. At the moment, my view is that there isn't enough information to be able to make those sorts of nuanced decisions. Tim might disagree, but there's not enough information to do that. But ultimately, there is no doubt that investors are making decisions around climate-related risks and opportunities, and they are which is why there is a flood of capital there ready for renewable energy projects, for hydrogen projects and so on, versus, you know, capital, mainstream capital disappearing from pure play coal companies and these sorts of organisations.
But are they being consistent? So they might apply that to Australia and Western countries, but are they applying it to investments in, let's say, China, the biggest emitter in the world by twice as much as the next one, the US, and China building 2 coal-fired power stations every week? So are they actually, you know, they might say they do, but do they actually apply it consistently for all investments around the world? So I guess personally I've got a
Sounds like two
skepticism.
great research questions to me.
Can I just throw in a red herring here? Because we're talking constantly about transition risk. We're talking about scope 3 emissions. I completely agree with all of the comments that are being made, but there's also physical risk. And physical risk, my understanding is what can also really change a boardroom discussion. Okay, so you might be exposed in terms of your scope 3 emissions, but it's when you understand that your assets and your operations are at risk, then you begin to actually want to act. And in terms of the data quality and the problems associated with data around scope 3 emissions, if you're talking about physical risk, the complexities there are on a whole other level. Scope 3 is easy in comparison. Scope 3 is easy. So I personally would like to see a lot more discussion around physical risk, because if you think, again, the points were made there well by Tim and Matthew as well, sorry. You know, the crisis that we're facing in terms of what's likely to come our way in the next 10 to 20 years, well, not even 10 to 20 years, let's say next 2 to 5 years, is considerable, and the impacts this will have on the various operations and assets of also public sector organisations, infrastructure, is going to be enormous, and that's, how do we measure that? How do we measure that?
Totally agreed on that. Maybe going back to the capital movement, this week's rather topical. We've got Brookfield bidding for Origin Energy. It's been a little bit of a feature. We've had the ACCC make a decision that it's in the national interest for a foreign company to bid and own an Australian company, notwithstanding the fact that that foreign company pays no corporate tax in Australia. Nevertheless, the ACCC said it was in our national interest on a net basis because Brookfield will deploy $20 to $30 billion of capital in the next decade to help decarbonise the Australian economy, and the climate crisis trumps everything, exactly as you said. That's what the ACCC has just ruled, and I actually 100% agree with them. And then the pushback on Australian Super, who's now trying to foil that bid, and I have been a little vocal on that this week. Australian Super has said they don't want Brookfield buying Origin Energy, but they're not willing to actually make any commitments themselves to allocating capital to accelerating the decarbonisation of the Australian economy. So I really do question why the Australian Super Board, who has millions of Australian members, it's meant to be acting on behalf of, yet it's not willing to invest in decarbonisation at the speed and scale the science says we need. And in fact, now it's going to block a foreign takeover to actually stop someone else acting on it. And so it really brings to me the question of what is the motivation of the board of Australian Super to be doing this so categorically this week? What is their objective? And I think that'll be one of the key discussions in Canberra. I'm hoping our Treasurer will be evaluating the boards of the major asset owners in Australia who manage $300 billion a pop, and saying, well, hang on, they've actually got a fiduciary duty. Are they acting in the science, in alignment with the science? And I'd argue in this case, they're categorically not.
Well, I think we're all looking forward to seeing how that one plays out in 2 weeks' time. I still have another 10 questions come through, so I think that just shows what a significant topic this is, a debate, and the quality of our panelists. So thank you to each of you. You were absolutely awesome. Thank you for the fisticuffs. You did a great job.
Vehement agreement, I think.
But we're all in vehement agreement. So thank you very much to each of you.
Thank you, Alison, and thank you the panel members giving us such an insightful perspectives. So we are drawn to the conclusion soon. Before I conclude, I have this long list of people I need to thank for organizing these events. Research Forum happens annually once a year, but it takes about 10 months to plan ahead, making sure the researchers are doing their jobs and making sure that we get the appropriate and right panel members to share their perspectives. So it does take a bit of work. So first of all, I'd like to thank all the audience here today. And many of you also flew from overseas just to attend this research forum. Thank you so much. And thank you for the audience on the virtual platform or also in Melbourne. Thank you, Professor Kathleen Herborn, to start the session today. It was an inspiring message that we should work with academics much more closely. And then we also had a very good keynote speaker by Alison White, some really great examples that she had given us. And I saw many academics actually put down the notes when she was speaking. So that was really insightful. Thank you, Alison. Thank you, all the presenters. Again, they only had 15 minutes to discuss their findings, which they spent about 10 months to do the research. And I'm pretty sure they're still doing the research at the moment, ongoing, improving the research findings. And hopefully, wish you all the best so you can publish these papers in journals. And think about the AASB SSRN working paper series as well when you publish. Thank you all the panel members. I could see that panel members, you didn't actually hold yourself back. You actually share your perspectives in a very honest way. Thanks for that. Thanks for sharing your perspectives. And also thank you for the moderators in moderating the sessions. We also like to thank the AASB academic panel members. They've been putting a lot of inputs into this research forum, giving us advice on the topics, and especially those academic supervisors that have been giving advices to the research teams when they're doing their work. I want to thank Melbourne session. Thanks, Keith, our chair, to facilitate the session from Melbourne. Our staff, Lachlan and Jia, also in Melbourne facilitating the session. Our board member, Dean Hanlon, is also in Melbourne session facilitating with the audience. Also, lastly, AASB staff, thank you so much. In particularly, Kathleen at the back, she's done an amazing job on putting this research forum together, lots of logistics. Of course, Justin as well, and MCI for putting these events. And I have to say thank you so much, Al Lee, for doing maybe 80% of the work. So really thank you. It's been a great session, and I look forward for the next research forum already, Al. So yes, so next year, we're going to again have our research forum happening. You'll get more information in the next few months. We'll announce that. It's going to be exciting. The topic is about accounting in changing times. And we know that we are in changing times at the moment. We're transitioning to not only to have to know certainties, but also uncertainties as accountants. So I'm looking forward to see you all next year again, and thank you for your attendance. We have a networking session now, so please feel free to stay here and network and keep the conversations going. Thank you, everyone.